All right, investors, let's cut right to the chase with ExxonMobil's latest earnings report. We're going to slice through the noise and focus on the three data points that really tell the story here: the core numbers, the growth engine, and the execution. Let's get into it.
So, CEO Darren Woods comes out with this huge claim, in a league of our own. Now, that's some serious corporate talk, but you and I know talk is cheap. What we care about is the hard data. So let's pressure test that statement and see if the numbers actually back it up.
Over the next few minutes, we're going to see if that claim really holds water. We'll break it down into those three key pillars. First, we'll hit the core financial results. Second, we'll look at the growth engines that are really powering this thing. And finally, we'll talk about the competitive moat that might just set them apart. Okay, Section 1, the report core. Let's get right into the headline numbers from this quarter. First up, the big one, earnings. They posted a solid $7.5 billion in GAAP earnings. That's the official by-the-book number. It really is the foundation for everything else we're going to look at today. But here's what really gets my attention: the cash flow. We're talking almost $15 billion in cash from operations. Look, earnings can be played with, but cash is king. This is the real fuel for the business, and it was driven by some seriously impressive record production. And this is what it's all about for us, right? The payoff. A massive $9.4 billion went straight back to shareholders in one quarter. That tells you everything you need to know about the health and cash-generating power of this company right now. So let's look at the trend here, quarter over quarter. You can see that upward momentum plain as day. GAAP earnings are up, sure, but look at the adjusted earnings, what we analysts call earnings X items. That jumped by a full $1 billion. And what's driving it? A big step up in production. Okay, Section 2, the growth engine. So that begs the question, where is all this record production and cash actually coming from? Well, it's not by accident. It's all about a very specific and very deliberate strategy. And this chart right here tells the whole story. They're shifting their focus to what they call advantaged assets. Just think of these as their best, most profitable projects. We're talking Guyana, the Permian Basin, and LNG. And look at this. For the first time ever, these star players now make up more than half of their total production. That is a huge fundamental shift. Let's put some numbers on that. In Guyana, production absolutely rocketed past 700,000 barrels a day. And why? Because their huge Yellowtail project came online ahead of schedule. That's a big deal, and we'll come back to that point in a minute. And it's not just Guyana. Back here in the U.S., the Permian Basin also hit a record, cranking out nearly 1.7 million oil equivalent barrels a day. So you've got these two absolute powerhouses, Guyana and the Permian, acting as the twin engines driving this whole machine. All right, Section 3, the moat. So having great assets is one thing, but lots of companies have good assets. ExxonMobil's argument is that their real edge, their economic moat, is something else entirely. It's all about how they execute. They call it execution excellence, and look, I know that sounds like a corporate buzzword, but what it really means is being able to handle these massive, mind-bogglingly complex projects on time and on budget and at a scale that others just can't touch. And the data here really speaks for itself. They are juggling 3 times more of these mega projects than their closest rival. And get this, they're doing it 10 to 20% cheaper and 20% faster than the industry average. That's not just an advantage, that's a massive, powerful competitive edge. And here's why that matters to you and me. All that efficiency, it flows directly to the bottom line. We're talking over $14 billion in structural cost savings just since 2019. That's real money, real tangible value created for shareholders. Which brings us to our final section, and maybe the most important one, the payoff. Because all this talk about production and efficiency is great, but what does it actually mean for your portfolio? Let's talk shareholder returns. Check this out. This is a timeline of pure reliability. They just announced their 43rd consecutive year of raising the annual dividend. 43 years. Think about that. Less than 5% of the entire S&P 500 can say that. In a volatile world, that kind of consistency is golden. And they're not stopping. The Q4 dividend just got another 4% bump up to $1.03 per share. That'll be hitting brokerage accounts this December. So if we look back at Q3's total payout, that $9.4 billion was split 2 ways. You got $4.2 billion from that reliable dividend we just talked about. And then they spent another $5.1 billion buying back their own stock, which, as you know, reduces the share count and increases the value of your existing stake. So let's bring it all home. Remember that claim from the CEO at the beginning about being in a league of their own? Well, when you look at the data, the record production, that strategic shift to their best assets, and this incredible project execution, it's pretty hard to argue with him. It's all translating into huge returns, which leaves us with the big question for the future. Is this the new blueprint for how to win in big oil? That's what every energy investor needs to be thinking about right now.